Hello, everyone. How are you guys doing today? I'm Harry Nima Segarra. Some of you guys, or many of you guys, may know me already. I've been here around like for 2 years in commercial real estate. Um, I am the founder and manager of Nima Equity, which is a commercial real estate and private equity company. And we focus on two main things, right? Like as you guys may know, the first one is education, like education of financial literacy and also in real estate and in different alternative investments in real estate and residential, commercial. And also we focus on passive real estate investment opportunities, mainly focused to the healthcare sector, physicians and healthcare professionals. Our company, as you may know, is founded and managed and run by physicians and for physicians. Today, I'm very excited to share this investment opportunity with you guys. And I'm here with two friends of mine, like we have known each other for, I mean, like almost 3 years now. Actually, in the past, we were together in a mastermind in a mastermind group. And we have known each other for quite some time already. And we have talked several times. And uh, over the years, we have talked about like possibly partnering like at some point. And that's also very important to disclose with you guys, like because also we have several friends and partners that we know each other for some time. So I have like talked with many of them, and again, like I'm very happy with what I've heard from Ryan and Warren. So yeah. So I mean, like again, so let's jump into this. And again, like before we go in the presentation, just want to share a little bit like about Ryan and Warren, and we're gonna go through that also in the presentation. They are full-time real estate investors, real estate professionals, which also means that they devote most of their time, or now pretty much all of their time, like in real estate, and they have combined decades of experience in real estate, construction and development, in insurance and finance too, which I found like very important. They are like the managing partners of Equity Yield, which is like also a real estate company that has over $200 million units under management, right? Like so, and they mainly specialize in class A and B properties, so what we call like the institutional grade, like multifamily properties. Today, we're going to discuss about this property. It's called like the Portofino Club, which is like it's a very unique property in the sense that I mean, like when you get into commercial real estate and you start doing education, you always hear about these kind of properties, class B in an area, in an A area, or class C in a B area. So which is property meets this criteria, right? Like so it's a class B property in a class A location. Is an off-market property. So which means like again, it wasn't on the it wasn't openly advertised, right? You guys can do a parallel like in the MLS for single family homes. Like it was not the case. It was an off-market property. It's a value add also, which again, like in this sector, we don't find that much common anymore, right? Like, and it's located in Jacksonville, Florida, right? Like which we pretty much know is a business friendly and landlord friendly state. Which again, like all those things are great and exciting. Um, as always, I want to let you guys know that like anytime we share an opportunity and we invest together with you guys. So we invest along our investors. We also we usually, or most of the time, we go and visit the property on site. So again, like I'm in conversations with Ryan and Warren to go in the next few weeks, like to the properties and tour that also myself. And not necessarily like again like going inside, but also like going around the property and seeing the neighborhood and all of that. And finally, as I discussed before, like the due diligence, right? Like I also do my due diligence with my partners and the operators, right? Like and thankfully I have this advantage, as I was mentioning, that I know already Ryan Warren for a couple of years already. I know about like the strong asset management skills, their vast knowledge. I mean, and that's all like also very important because you guys know like I do a lot of education. They also do a lot of education, but also for already people who are in real estate. So you can imagine like the level of expertise that they have. right? Like, and again, they have a background on like in construction and asset management, which is great. So let me get started. I'm gonna share. You guys are okay. I start sharing my screen, and okay, does it look okay? Probably, and I'm gonna put this to minimize. Are you guys okay? Can you guys see my screen?
Yeah, we can see it.
Yep.
All right, awesome, very good, very good. So let me get started. Like with this, I'm gonna minimize this part, and we get started, right? Like again, like Portofino Club is a 230 unit, 1986 construction or Class B property in an A plus location in Jacksonville, Florida. Just start with some disclaimers. Of course, all financial information and projections are provided for reference only and are based on assumptions relating to the general economy, market conditions, and other factors beyond our control. Prospective investors, if you're interested to invest, are encouraged to conduct their own independent due diligence investigation, review financial projections, and consult their legal tax, and other professional advisors before making an investment decision, right? And we're going to share this presentation so you can read the rest of that, right? But again, like the information provided herein is to remain strictly confidential and is intended for accredited investors only. And you guys probably know what that is because we usually share this information in our newsletters. Just a little bit about myself for anyone who doesn't know me yet. I'm a full-time pulmonary critical care doctor. My wife and I, we both are physicians. We live here in Dallas, Texas. And over the last 6 years, we have been investing actively and passively in real estate, residential and commercial. We still own and manage a portfolio of single-family homes and small multifamily here in Dallas. But in the commercial side, we also are very involved, and I have been involved in acquisition, sourcing capital, and asset management in multifamily syndications. We're proud to have good partners, and now like we're co-sponsors in over 1,100 apartment units in different states, with 90 million of assets under management. And as you guys know, like that's very important for us, the core for us. Lima Equity focuses on financial and real estate education for physicians, and we have our YouTube channel of the same name. And now, without further delay, I'll pass presentation to Ryan and Warren.
Thanks, Harry.
Mhm.
Appreciate the introduction. I'm Ryan Webster, as you mentioned. I'm one of the managing partners here at Equity Yield Group. I'm a professional real estate investor and entrepreneur, as well as a National Home Builders Association award-winning home builder. Prior to founding Equity Yield Group, I owned and operated a construction development company, gaining over a decade of experience in business and real estate, having managed over 2,300 projects to completion, ranging from single-family custom homes, value-add multifamily, commercial and retail space. And I've been able to leverage this knowledge here at Equity Yield Group, which has allowed us to deliver our value-add construction projects consistently, under budget and ahead of schedule. With that, I'll pass it to Warren.
Thanks, Ryan. So I'm Warren Dresner. I've been investing in real estate since 2010, and prior to that, I have a background in finance and insurance. In addition to being a general partner in multiple multifamily syndications and a managing partner of Equity Yield Group, I'm also a passive investor in more than 20 syndications. So I understand the perspectives of both being a limited partner and a general partner in syndications. I'll also talk a little bit about our group. On the left-hand side of the screen, you can see, as Harry mentioned, we hold more than $200 million of assets under management. Our focus at Equity Yield Group is on acquiring and operating institutional grade multifamily assets in great markets, sourced, qualified, and managed by an experienced team. But one thing we're very passionate about is that with every investment, we strive to provide an outstanding investor experience, not just in terms of returns and the way that we manage the asset and the operations, but also in terms of transparency, consistent communication, and reporting. And this one is going to be no different to that. So we're really excited to present this opportunity for Portofino Club Luxury Apartments in Jacksonville, Florida. There are a number of reasons why this is a great looking investment. It's a B-class asset in an outstanding location within Jacksonville. And we'll talk more about the specifics of the location over the next few slides. But suffice to say, it is primed to take advantage of population growth and income growth in Jacksonville over the next few years. The property is being purchased off market at a great pricing basis, well below initial pricing guidance and 23% below recent comp sales in the area. We're buying the property with assumable debt. The debt has 49% leverage and an interest rate of only 4.99%. Which is much lower than the rate that you would have on a new loan that you take out today. And Portofino Club is a proven value add opportunity. 98% of the units are eligible for renovations and upgrades, and renovation premiums are estimated to be an average of $292. Now, one of the reasons we love this opportunity is because the market environment into which we're buying is extremely favorable over the next 5 years. Population and job growth in Jacksonville has been extremely high in recent times, averaging 2.85% per year compared to the national average of only 1.35%. And growth is projected to be higher than the national average over the next 5 years as well. The other aspect of the macro picture is supply of apartments. Now, over the last 12 to 18 months, there's been a lot of supply that's come online in parts of Jacksonville, and that's affected the business plans of many existing operators in the city. However, in this pocket where we're buying, supply is now limited. There are only 265 new units projected in the area within the next 2 years. And those 265 units are actually townhomes, which are not directly comparable to Portofino Club. So in actual fact, we have no new competing supply of the same product type in the medium term. And when we combine that fact with meaningful growth in population over that period, we're expecting favorable tailwinds for this investment in the medium term. Now, I mentioned that the location of Portofino Club is outstanding. The median incomes in the census tract where Portofino Club's located are north of $82,000, and the average household income in the zip code is north of $111,000. The Hidden Hills neighborhood where it's located is an attractive and desirable place to live, and the location is definitely a positive attribute for this investment. In terms of the investment metrics, we have an 8% preferred return for investors. This means that investors get the first 8% of returns before general partners receive any payment. We're projecting a 17.6% IRR and a 22.5% annualized return, and an equity multiple over 5 years of 2.12x. The minimum investment is $50,000, and we have a funding deadline of 25th of June, 2024. We're due to close on the property the first week of July. And if we look at returns in greater detail, you can see projected cash flows for the 5-year hold period. As with our previous investments, we make monthly distribution payments to investors. So you can expect to receive monthly payments over time. We also like to show the sensitivity around our major assumptions. So in the table at the bottom on the left, you can see how our projected returns vary with our exit cap rate assumption. Now, our base case assumption is an exit cap rate of 5.75%. CoStar is actually projecting a 5.3% exit cap rate, which would produce substantially higher investment returns. We show outcomes for as low as 5% exit cap rate and as high as 6.5%. And you can see that on this basis, the IRR could be 13.5% in the low case and as much as 20.4% in the high case. The equity multiple could be 1.78 in the low case and as high as 2.38 times in the high case. And then just on the right-hand side, investors will also share in depreciation benefits from a full cost segregation study. We estimate 40 cents in the dollar depreciation benefit in year 1 and 75 cents in the dollar over the life of the investment. Now, on this deal, we're also partnering with both ATX Acquisitions and ResProp Property Management. These two firms actually have the same ownership. ResProp is our preferred property manager in Florida. They currently manage 4 other properties for us, and they do a great job. ATX Acquisitions is their investment arm. And you can see that ATX has a long, successful record in multifamily, purchasing over $2 billion of assets and returning an average of more than 20% returns to investors over that time. We like the fact that ATX is part of this deal, It shows that we have the backing of a large institutional operator. And the fact that ATX and ResProp have their own money in the deal means that we're confident that they will help to manage the asset with their absolute best efforts and their best team. And on the following slide, you can see the track records of both Equity Yield Group and ATX. We at Equity Yield Group have a focus on Florida, and since our formation in 2019, we've shown strong operational performance across all assets. You can see some stats for each property, including our original projections, as well as our latest projections for returns for each of these assets. But what we pride ourselves on is a real focus on asset management, construction management, and investor communications throughout each business plan. ATX acquisitions and the team behind them have purchased more than 17,000 units. And like I mentioned, they've produced positive returns for investors, an average IRR of 20.8% and an average equity multiple of 2 times. So we're really confident that we have a very strong team on board for this project. Now, when we're looking at an investment, we always start with the market because we want to be riding the wave of a market rather than fighting against it. So let's start to look at Jacksonville in greater detail. You can see on the screen, Jacksonville has experienced significant historic population and job growth, and it's expected to continue this with 10% growth over the next 5 years. In terms of business activity, Jacksonville saw 23.8% growth in GDP from 2017 to 2022, which is almost twice the national average. Employment's been growing at 3.5 times the national average, and the median household income has grown by 38% over the last 5 years. And what all of this means is that there is a high demand for housing in Jacksonville, given all of this growth. And these are the types of markets we want to be investing in. If we turn to the next slide, we've got some additional detail on the industry in Jacksonville. There's really high job diversity, where you can see that jobs are coming from multiple industry sectors. And this lowers the risk of investment in any market. Jacksonville's a major financial center in the Southeast with a large presence of a number of Wall Street firms. And it's also an important logistical center and distribution point, with goods being transported from the sea, north and south along the eastern seaboard, and west to the rest of the US. And that creates significant logistics and transport jobs as well. So as mentioned before, in the medium term, this is an ideal market that we love to invest in, given the fact that there is so much growth coming into the city in the next couple of years. And within this context, I will now pass it along to Ryan, who will talk more about the specific opportunity with Portofino Club.
Thanks. As Warren's explained, the property is well located in a great area with growing and diverse employment market, high median incomes, and limited future supply. So now we'll discuss a little bit more about the property itself. The property consists of 230 units built in 1986, offering studio, 1 and 2 bedroom floor plans. The community has a great existing amenities offering: the large pool, shaded poolside cabana, outdoor kitchen, fire pit, a putting green, a business center, fitness center, and lounge entertainment area in the clubhouse. And the property is in good condition, with prior ownership having already deployed over $2 million in capital improvements. They've installed new roofs on all the buildings, new siding and exterior paint. They've also replaced a large number of HVAC units, which significantly reduces the future deferred maintenance needs of the project. Additionally, prior ownership has begun an interior value-add renovation program, which has achieved average rent premiums of $292. Our business plan will leverage the favorable market conditions to drive long-term growth over the life of the project. And we plan to renovate an additional 175 units over the first 3 years of our business plan to capture the proven rent premiums from the prior owner's renovation program. We'll take a look at our interior plans here. Our interior renovations will bring all units of the property to a uniform renovated scope with solid surface countertops, tile backsplash, stainless steel undermount sinks, stainless steel appliance package, upgraded faucets, recessed LED lighting in the kitchen, and upgraded light fixtures throughout, as well as a full repaint with updated color palette, and we'll be installing new LVP flooring in select units. Additionally, we plan to grow ancillary income through implementing valet trash service and a bulk cable contract, and capturing additional washer-dryer fees as we install the remaining equipment across the rest of the units. The total renovation budget for the project is $2.9 million, 1.8 million of this is allocated to interior renovations, which is roughly about $8K per unit. So the proven rent premium for these renovations equates to a 42% 12-month return on cost, which well exceeds the industry target of a 20% return on cost. And as a former developer, one of the aspects of this project I find really appealing is the supply and demand dynamic in the immediate area. While the broader Jacksonville market has been saturated with new supply over the last 12 months, the properties located in the submarket of Jacksonville that have received very little new supply due to the lack of available land. The area is projected to continue strong population growth with an estimated 4,387 new residents within a 5-mile radius of the property. This will continue to put significant demand pressure on the limited housing in the area. And I believe due to the high cost of financing development deals right now and the significant lag time of construction and getting development projects out of the ground and delivered to market, it'll be at least 3 years before we could see any meaningful supply to the pocket here, provided developers can find land suitable for building. This limited supply and strong, steady demand will continue to drive rent and revenue growth over the long term. You can look at the rental comps. The direct rental comps in the area show significant support for demand for a renovated product. Brookwood Club and Meridian have both implemented value-add renovations with a limited scope consisting of resurfaced countertops, new flooring, and paint. And these properties have seen rent growth over the last quarter of 0.5% and 4.5% respectively, while Cypress Cove, which is not renovated, posted 0% rent growth over the last quarter. And Portofino's prior ownership has implemented a superior renovation scope with solid surface countertops and better quality finishes, which allowed Portofino to outperform the comps, posting 8.1% rent growth over the past 12 months, proving that there's significant demand for a better tier of renovated product that still provides an affordable price point compared to the more luxury late 2000s product. Relative to sales comps, our purchase price is very attractive, which Warren kind of discussed, but we did manage to get the property off market at $148K per unit, which is an $8.5 million discount from the previous list price when the property was listed about a year ago and fell out of contract. And our going in basis is very attractive at roughly 23% below the average sales comps. The only two properties that have traded at a lower basis are the Meridian and Madison Manor, which are located in pockets higher crime and weaker demographics. Move on to our overview of the investment itself. So as Warren had mentioned, LP investors will receive an 8% preferred return, a 70-30 split until they reach a 16 IRR. Thereafter, it will be a 50-50 split between investors and sponsorship. All the investors will receive their proration of tax benefits and depreciation, and the year one depreciation is projected to be 40 cents per dollar, while the overall depreciation for the term of the project is projected to be 75 cents per dollar. The senior loan is low leverage assumable loan at 49% LTV. It's a 30-year amortizing agency loan at a 4.99% fixed rate, and we'll be pulling a supplemental loan, which will take the debt leverage is 63.4% LTV, and the rate on that is 7.97. The blended rate between the two loans is 5.67, which is well below what current market rates would be today, or about 6.7. And sources and uses for the project consists of the $16.9 million assumable loan, the $4.8 million supplemental loan, an $8 million preferred equity placement from Related Group. Related's a large institutional investment fund with more than 100,000 apartments worldwide. We've partnered with Related on past projects, and they've proven to be a valuable partner. And the pay rate on the preferred equity is 6.5% current with 6.5% accrued. Related will have no participation in the upside, but they will be providing future funding for our capital improvements and renovations, which allows us to save carrying costs by not paying interest on that capital day one. And the total common equity placement is projected to be approximately $11 million. Uses of the capital consist of $34 million to the purchase price of the property, $2.9 million towards capital improvements, $120K in closing and soft costs, $1.5 million in prepaid tax, insurance, working capital, contingency, and $618K acquisition fee. Just quick review of some of our underwriting metrics here. Our going in cap rate is 6.06, which represents positive leverage or senior debt. Our projected median exit cap rate is 5.75, 45 basis points above CoStar's projected cap rate. And our exit price per door is $233K, which is $60K below CoStar's projected sales price of $293K. We're charging a $292 renovation premium, which has already been achieved and proven out by prior ownership's renovation program. And we're projecting 2.9% average market rent growth over the hold period, with only 1% rent growth in our first year. And then we're underwriting a hold period of about 5 years. That's when the term on the existing debt will run out. We plan to exit via sale. However, given the low going in basis and low leverage of the existing debt, there is a potential for an exit via refinance. While this is not our base case scenario, it's certainly a possibility. And based on our projected NOI and sizing interest rate to the forward curve, it's possible that a refinance in year 3 would take out the senior loan, the supplemental loan, and the preferred equity. And the new interest only on the new loan and removing the preferred equity payment would boost cash flows for investors to almost 13% annually. So having the possibility to exit via both a sale or refinance removes the risk of return of capital being reliant on only one possible exit. And then our operating break-even occupancy is 45%, and our break-even occupancy, including debt service, is 74%. The property has historically run 95 to 98% occupancy, and it continues to outperform the comps and the submarket. Year 1 DSCR on the blended debt is 1.55x and averages 1.81 over the hold period. And then the year 1 yield coverage for the preferred equity current pay is 2.61 and averages 3.69 over the hold period. So we do run a very detailed underwriting and review process when putting together these business plans and projections. But as professional investors, we recognize that investing is based on a range of potential outcomes weighed against potential risks. So for that reason, we always like to provide investors with a sensitivity analysis showing projected cash flow sensitivity to rent growth and occupancy. So based on a 600 basis points range for rent growth and occupancy, year 1 cash flows could range 3.9 to 6%, our base case being 4.9%. Overall cash flow for the life of the deal could range from 5.6 to 7.5. Our base case is 6.6. With that, I'll hand it back to Warren to talk about next steps for taking advantage of this opportunity.
Thanks, Ryan. So in terms of post-acquisition expectations that investors should have, you'll be receiving monthly updates from us informing you of operational and financial performance. These updates will come out on the same day every month like clockwork. You'll also receive monthly distributions. These monthly distributions are expected to begin after 1 quarter of ownership. So it'll probably begin either month 4, 5, or 6 of ownership. And finally, in terms of communication, we always clearly and quickly communicate the status of progress at the property at all times. And we genuinely do take pride in being open and available for any investor questions at any time. So if we move to the next slide, the next steps, the investor documents are now available. So you will need to review the documents and complete the investment packet that contains the offering documents. This is a 506c offering for accredited investors only. So part of the process will be to verify that you are an accredited investor. We will then review the documents to make sure that they are all in order, and you'll then need to wire the funds. The deadline for wiring is 25th of June. We do expect this offering to fill up quickly. We already have soft commitments for more than half of the funds, and we will accept investments on a first come, first served basis based on when the funds are received. So although we have a deadline here of June 25, we may in fact close the offering prior to that date if it fills up. Closing on the property is currently planned to take place in the first week of July. There's a $50,000 minimum investment amount, and we are accepting investments from IRAs, solo 401ks, EQRP, trusts, LLCs, as well as on an individual basis. We do have a couple of slides in an appendix, which you can have a look at in your own time, just showing the full pro forma over the next 5 years. But with that, I think, Harry, we can pass it back to you and answer any questions that you may have.
Yes, yes, man. Thank you. That was a great presentation. But give me just 1 second. I'm stopping sharing this. And yes, no, I mean, like that was a great, very direct, straight to the point presentation, which I love, and also like many of our physician friends really like. Yeah, so I have a couple of questions, like again, like and I'm sure that some of our investors and friends will have them too, right? Like so, the first question is like, I mean, like everyone has heard about like some headwinds and challenges that real estate in general has experienced, probably more in the sense of offices and commercial real estate, right? Like, but it seems like there are a couple of, and we have heard a couple of times that some projects are experiencing problems, and some of them have made capital calls. So probably that's going to be one of our questions that our investors will have. If you guys as a company have had any capital calls with, again, like which again is not like something um, weird to happen like in the current landscape, but also if that happened, how you guys were able to manage that, and what was your approach to protect investors' capital?
Sure. Yeah, it's definitely been troubling times recently. I think almost all of the capital calls that have happened in the last year or two have been because the assets were purchased with variable rate debt, bridge debt. Most of what we own is bought with fixed rate debt. We did have one asset that was on variable rate debt though, Bradenton Reserve, which was one of the assets I talked about earlier in the presentation. That one actually really outperformed on an NOI basis. Rents were much higher than projected. It was performing well. But the plan was always to refinance that one in the second year of ownership. And we did begin a refinance process into a HUD loan. And as some people might know, HUD loans can take a long, long time to actually come through, sometimes 8 months or 9 months.
That's right.
So what happened with that deal was we planned the refinance. We were expecting to be able to take money out after the refinance. But given that interest rates moved up so quickly while we were in that 8 to 9 month waiting period, what eventuated is that in order to complete that refinance, we actually had to put $2 million into the project. So it turned out into a cash in refinance. So the way we managed it, first up, we communicated this possibility early to investors, and we kept communicating to them while we were waiting for that loan as we saw interest rates climbing. When we knew the quantum of how much money we would need, we explained clearly the situation to investors. And we spoke to a number of investors and asked them their preference. Would they prefer that we did a capital call? Would they prefer that we get a loan to fund that shortfall? Or would they prefer that we go to another equity source and bring in preferred equity? And based on that feedback, the consensus that we got was that we should actually not do a capital call, but seek a loan. We offered all investors the option to participate in that loan. So they had the option to lend money to the project if they chose. This was not compulsory. So some investors did choose to lend the money. It was an attractive interest rate, but some did not, and that was fine. And then we sought the balance of the loan from outside investors as well, but only after we'd given the choice to investors. So in the end, it wasn't strictly a capital call, but it was a situation where we needed to inject extra capital into the project. But the key success factors, I think, were that we communicated to investors from very early on. We kept up consistent communication along the way. And then we tried to treat each investor fairly and ultimately made a decision for the long-term benefit of all investors.
Yeah, no, that's great. And actually it probably is important to remember that it is because the property was so well managed that you were actually having these kind of options, right? Like, because otherwise it would have been impossible for the size and the value of these properties, right? Like, which are usually over the 20-30 million dollars, right? Like, so yeah, that's great.
We were in the fortunate position that the property was performing really well. So I don't think there was much thought that people were throwing bad money after good money, which I think is the occasion with some deals that are having capital calls at the moment.
Absolutely. Yeah. So on that same line, I'm sure also like everyone is aware of the interest rates and the Feds, what has been going on since 2022 March, which all of us are very aware. So how are you guys putting that into the equation? And I know like we already discussed that a little bit like during the presentation, but it's probably important like to just tell our friends and investors just a little bit to remember about that, right? Like what are you guys expecting in the next 2 years? And probably that's something, as you're saying, like you guys like usually fix debt, and that is the case. So what can you say about that?
So the biggest mitigant against interest rates is the fact that we are using fixed rate debt here. So over the next 5 years, it frankly doesn't matter if interest rates go up further. Doesn't matter directly. Ryan did mention that one of our exit strategies may be to do a refinance. And if we want to do a refinance, it does make a difference what interest rates are. And when we sell the property as well, it does make a little bit of a difference what interest rates are, because that affects the next buyer's potential cost of debt. So in the short term, we're not worried about interest rates because we've fixed our interest rate and we're assuming debt with very low interest rate. My personal view is that I don't think interest rates are going to come down anytime soon. I expect them to stay pretty stable for the rest of the year. Maybe we'll see a small rate reduction towards the end of the year, but I think there's a good chance that we won't see a reduction until the following year.
Absolutely. Yeah, no, that's important. Then the next question comes like we are investing in Florida, right? Like so there have been something on the news about like some challenges with insurance, like especially in states like Florida, Texas, California, and also like the taxes, right? Like I guess like anyone who has invested in real estate in the last 4 or 5 years have has to deal with that like in different ways, right? Like because we have like Arizona, Texas, they're like different. Florida is also different. So how are you guys putting that into the equation?
Yeah, a couple things. Florida definitely has been an interesting insurance market over the last couple of years, but things are definitely improving. We've got a couple insurance renewals on some of our owned assets where premiums are coming down. But one of the advantages of having ATX and ResProp as a partner in this deal is they have a master policy across their entire portfolio. So in terms of access to coverage, which was definitely an issue 18 months ago, we have a little better access to the coverage and we have a little better pricing than people that would be shopping for a standalone policy. And then in terms of taxes, compared to other markets, Florida's taxes are relatively stable. They do reassess at closing. But after that, the increases are relatively minor. In addition to that, we're doing a tax bifurcation appraisal, which we've done in the past and had great success with. Effectively, what it is you hire an appraiser and they break out the value of the real property versus the value of the business when you're doing the overall purchase. And then they allocate the real property, and that's what you use for your taxable basis for your real estate taxes. So in effect, it usually ends up reducing the taxes anywhere from 18 to 30%.
Great. That's great. So just probably the last question, something that you guys also are aware, comparing to 5 to 7 years ago when other market was very favorable, and pretty much we have seen like many properties come to the market with not much done to in the sense of the business plan. These times are very different, right? Like so these times really required strong asset management skills and to have a really strong property management company on site. And even though like this is very geographic as real estate too in terms of companies, like that's something that I believe that you guys have a great partnership with Respro and also their capital side, right? Like so, how can you guys tell us a little bit more how has been working with them over the last 3 years?
Yeah, it's been a great working relationship, and third party management is it's not always great. We've had a great partnership with ResProp as long as we've been working with them. And with that, we've had a lot of influence into, the processes that they run at the site level and even the regional level, and their cooperation and, delivering on what our expectation is in terms of those processes, and even down to the point of who they hire and the team that's, directly managing our sites. They've been willing to take a lot of our input in regards to that, which has led to a lot of benefits in terms of operations. And then on the operations and asset management side, that is really where our strength is, and where we excel, is being able to directly affect performance by affecting how operations run at the site level, as well as on, the value add renovations, and being able to run an efficient process there by just removing a lot of the unknown variables.
Right. Awesome. Yeah, no, I mean, like that's great, right? Like, so, Ryan and Warner, I really appreciate your time today and spending some time with us and our investors for this really exciting opportunity. Guys, so just wait for the following communications and emails. I'm gonna get like some more information about this investment opportunity. And Warren and Ryan, thank you so much for being here. I'm not sure if you guys have anything else to add.
Thank you very much. We look forward to partnering with many of you on this opportunity.
All right. Thank you, guys.